Well, Michael, here we go again. We are trying this experiment where we're essentially interviewing different practitioners where their level of expertise or industry inevitably overlaps with what we do in the family law context. So who are we talking to this time?
Yeah, and next we're talking to Greg Raffaele. He's a forensic accountant. Something that's very, very important that overlaps with family law is something you guys won't want to miss. I'm here with Greg Raffaele, forensic accountant, someone family law practitioners like myself often utilize. Welcome, Greg.
Thanks for having me, Michael.
Greg, can you talk a little bit about yourself and what you do?
So as you mentioned in this intro, I'm a forensic accountant, but a lot of people don't know what that is. So as you know, and as you often hear, there are some financial issues in family court that attorneys need the help of accountants who specialize in family law, because in the accounting that I do, it's oftentimes seen as an intersection between law and accounting. So as forensic accountants in this space, I have to know the law because I have to apply the law in how I, in fact, do the accounting. I've been doing this for 23 years. I started my practice in 2003, at the very beginning of 2003, so that's about 23 years. And I have the credentials that make me a qualified expert in family court. So I'm a CPA, or a certified public accountant. I'm also a certified valuation analyst, because as we'll probably discuss later on, there are some aspects of property division that include the business that is either the community's business or maybe one of the spouses came into the marriage with that business. And then I've got other credentials that are not as significant and rarely recognized, so I'd rather not speak about that. But for the most part, 95% of what I do is litigation, and about 5% is out-of-court settlement, or what you guys refer to as alternative dispute resolution.
And you mentioned businesses, and I want to talk to you about that because that's something that's common for us family law practitioners, where we have a spouse that has a business, and as you know, most people probably know, when it comes to support, people aren't very forthcoming with their income, right? So what's your role with determining the value of a business and the income that the owner of a business has for purposes of support?
Yeah, it's actually a very common question, because oftentimes my clients and the attorneys that call me that have clients, there's always a business involved. And the income is always the question. And the business value is derived from the income of the business. So in a nutshell, the more profitable a business is, the more valuable the business. But the question is the profit that the client or the litigants or the parties in this case, is that the real profit of the business, or is it, like in most cases, is it in fact below what it really is? So ultimately, as a forensic accountant that specializes in business valuation, I must first determine the accuracy of the profit or the income, and from that point on, I can value the business.
Do you find yourself oftentimes when you're dealing with businesses or business owners, do you deal with a lot of resistance from them or lack of cooperation when you're trying to conduct your evaluation of these businesses?
Yeah, so the reluctance is always with the owner-operator, or what we call the in-spouse, because there's this mentality, rightly or wrongly, there's this mentality that the in-spouse, that's the one who came into the marriage with the business, or the business during marriage, they feel that they in fact built this business. It's their business, it's their baby, and they don't want to divide it. Also, if they're grossly underreporting their income, they also don't want to be found out, so to speak, because there might be some consequences in their mind. So they are very reluctant about doing these things. So there's always reluctance, but for the most part, the reasons why are the ones I just mentioned. They think it's their baby, and they don't want to divide it, or they've essentially underreported their income, and they don't want to be found out, which may have some other consequences if they have done that.
When evaluating different kinds of businesses, are there certain businesses that you find are more difficult to evaluate?
Surprisingly, the problem here is that the businesses that are easy to value are the ones that have very strong financial discipline and internal controls, which are generally the larger businesses. The small ones are challenging because there are no controls, financial controls, or there's no financial discipline. For example, I find that owners of small businesses, they tend to commingle their personal lives with their business lives. So now we have a problem because in their reporting of their business, which is at the very least their tax return, you may have, actually you always have, essentially personal expenses being paid for by the business that are being deducted as business expenses. So now we have to essentially take a bank statement that has personal and business expenses and try to filter, if you will, the business expenses so we can true up the profitability of the business. But there's another problem here is because a lot of people think that just because they have a meal and they talk about the business, it is automatically a tax deduction, and that's not the case. So I also get pushback there because they said, well, my golf trip or my meal with so-and-so, we talked about my business for 5 minutes, and that counts as a business expense, and that's not the case.
Well, you mentioned expenses, so I want to talk to you about add backs. Can you talk a little bit about that?
Yeah, so the starting point, as far as I'm concerned, are the tax returns, because there's a fancy phrase in family law called, the tax returns are presumptively accurate, right?
Right.
So that's always a starting point, whether it's the individual taxpayer's tax return or is the business's tax return. So we start there. But as I said earlier, the profit that is being reflected on the tax return is not always accurate because many business owners, actually from my 23 years of doing this, all business owners, it's a matter of materiality, they always add back personal expenses, or they always include personal expenses as a business deduction. So add backs in general starting with the bottom line is the tax profit, and we're adding back personal expenses. In other words, expenses that the business does not need to operate that business, and in all likelihood are in fact personal. So there are many examples. For example, I've had clients that have country club memberships, but they're plumbers.
Right.
And they rationalize that. It may sound extreme, but one of my richest clients happened to be a plumber. Okay, and this person had a country club membership. He played golf. Okay, so and he would deduct his country club membership. And my question to him was, how many clients have you actually gotten from your country club membership? And he said 0, right? But he argued that was just a marketing expense. He said that I have never stopped trying to market, but I just never get any clients from there. And I said, well, you know what? I think that a business owner, if he were to sell his plumbing business, would not expect the business buyer to incur that country club membership as an ordinary business expense. So I had to add that back to the profit of the business. So once I true up the profit of the business, I now can value that plumbing business.
That's a great point. So you talked a little bit about the business component, but let's talk about how you actually go about evaluating a business and what that process entails.
Yeah, it's a very good question. So technically, and I don't want to be over technical here, there are 3 ways to value a business. Okay, there's a market approach, okay, there's the income approach, and there's this thing called a cost or a hybrid approach. So the market approach essentially has, you may have heard this, like price to revenue, price to discretionary cash flow, and then the income approach has to do with this thing called a discounted cash flow that's largely used by forensics for larger businesses. But the most common one is this cost approach or this hybrid approach. It's called the excess earnings approach, which the courts are very comfortable with. So, but basically, no matter which method you use, you have to combine 2 things. One is the tangible value of the business, right? That's essentially your assets that you can touch, like this furniture here, right? So you have equipment, furniture, vehicles, those are all the assets, right? Then you subtract, of course, your tangible liabilities. Well, not really quite tangible, but you have, for example, loans against your vehicles. So you take all your assets that are tangible, that you can touch, subtract your loans against the assets that were leveraged or that are encumbered, and then you come up with essentially your net tangible asset. But from that, you have to add this thing called goodwill. So every business has 2 components. There's a tangible asset, Okay, and there's a goodwill component. You add those two depending on whichever approach you want to use or whatever method you want to use, and the combined value is in fact the value of the business. Now, that's only the first step. The second step is, in many cases in divorce, is that business 100% community, or is in fact, was there a party or a litigant or a spouse that brought this business into the marriage? So now we get into how do we divide that business between the community and what somebody brought into the marriage with, and that requires this concept of characterization, and there's case law specific to how we divide those things.
You know, and I'm glad you mentioned goodwill, right? Because goodwill is something that's not tangible. And people may differ in opinions as to what goodwill is or how much value you place on goodwill. So how do you do that? How do you assess the goodwill of a business?
That's actually a very good question. And in fact, among forensics, that's the biggest debate. You can never have a debate over the tangible value of a business because you know exactly how much those cars are worth, because there's a thing called a blue book, right? For example, you know exactly how much the receivables are because these are invoices you've actually issued and you haven't been paid yet, right? You know exactly how much the loans are because there's a balance that you still owe, right? But the question is, how much is the goodwill? And this thing called judgment among forensics, how to use a multiplier against the income that we've trued up as experts, as forensics, that we in fact get a measurement of that value. For example, if you have a law practice, let me speak closer to home. If you have a CPA practice, oftentimes it's between 0.85 or 85% or 1.15 or 115% of the gross revenue. Okay? But a CPA firm is largely goodwill because nobody cares about the furniture at a CPA firm, right? Yeah. So you're really buying the book of business, or you're essentially buying the annuity or the income stream today, because if you buy a practice today, you're hoping to receive that income stream over a certain period of time. So the question is, for goodwill, is how durable, how much of a guarantee do I have as a business buyer of a CPA practice that I can receive my money back, right, and profit after that? I'm talking about this thing called return of your investment and return on your investment. So the way it works is the lower the risk, the higher the value. So if I were to assign a multiple of 0.85 off the CPA firm, that means the risk is higher because my multiplier of 85% against gross revenue is in fact the lower end of the spectrum of how CPAs are valued. If I in fact sell my CPA practice at 115% of gross revenue, for example, that means that the risk is lower. What risk is that? Is that the risk of actually receiving my future income stream as a buyer, because you're buying the future as a buyer. Goodwill tells me essentially it's a guarantee that whatever I buy the business for, I can get my money back, and I can always get get a profit or return on my investment after some time.
Right, and that makes sense. That makes sense with goodwill and the type of business you're acquiring, and I appreciate that explanation.
Oh, you're welcome.
Hey, Craig, so I want to piggyback off some questions that Michael was asking, particularly as it pertained to business valuation. And you were touching on multipliers, right? Or in essence, you were kind of giving the broad stroke of what a multiplier is. Can you talk a little bit about sort of the significance of that when sort of valuating a business? That makes sense.
No, it does. So the significance is to essentially the husband, for example, who has to buy out his wife for the half that belongs to the community, right? So she gets one half the community, for example, right? So it's significant because if you overvalue a business, then whoever is going to divide that business and buy out the other person now is essentially overpaying, right? Or in contrast, if you undervalue it, the one that's receiving the buyout, the outspouse, is going to be receiving less. So we now have to say, well, what's the fair value? And there's a standard called fair market value. And there's a technical definition, but ultimately the focus is this thing called fairness or equity. Now, how we remove ourselves from being subjective in business evaluations is we have these publications that give us an idea of what the market is for certain kinds of businesses. I mentioned a plumbing business, so there's a multiplier in these publications that show historically plumbing businesses sell for between, let's say, 1 and 3 times sellers' discretionary earnings, as an example, plus the assets. Because when you buy a plumbing business, you're going to have inventory, for example, presumably a fleet of trucks, okay, tools and equipment, right? So there are these publications here. But don't quote me on the 1 to 3 times sellers' discretionary earnings, because I need the books to in fact confirm that. I'm just giving you an example. But the significance here is that you have the risk of either overvaluing or undervaluing, which is going to affect either the one that's buying out the other person or the one that's being bought out.
Makes sense. I want to ask you a question because, I think that it could be phrased this way. Is it a job or is it something more than a job? And let me kind of get to where I'm going with this. And I think you already know. Yes. Let's say, for instance, I'm getting divorced, right? And I have my law practice. Well, how do you value my law practice when in large part the value can in many respects be derived of what I bring, what I actually do in relation to, and you were talking about this with Michael, right? Tangible assets. There's not a whole lot, right? I have some computers, maybe a conference table. So talk a little bit about that.
Right. So it's actually a very good point because the question is it really a salary or a job, or is it a business? So there is a very fundamental threshold to touch on your example. Well, I don't think you're getting divorced, but okay.
Hopefully not.
Okay. So if, for example, you, with your education, training, and experience, can get a job in this field for $250,000, okay? And you as a business owner have profit before you pay yourself equal to $250,000, you, Jason, have a job. Now, the incremental profit in excess of that $250,000 in my example, okay, your practice, that's when you start getting this thing called goodwill. Because the theory is this concept called replacement value. If I was a step away, if it's possible, if I'm Jason, step away from my practice and hire somebody else and then pay them $250,000 because they have your same education, training, experience, and my profit after I pay them is $50,000, then now I'm now an investor of my business and I'm getting a return on my investment. So I'm buying a business. I happen to replace myself with somebody that's equal or comparable to me. Okay. But if I have profit before I pay my replacement of $250,000 and my profit and their worth or their salary is $250,000, I'm essentially just replaced myself and I have no profit to derive from my business. So essentially, that's just a job or a business. That's a job or a salary.
Yeah, no, great point. And certainly something we see often with litigants and spouses maybe saying, well, it's got to be worth more than that. It absolutely has to. And it really effectively boils down to what you just explained and how you're sort of assessing whether or not it's a job or actually a business. I did want to ask about a common example and something we see often where, let's say, for instance, you have a couple, husband, or before they're married, husband purchases a house, right? And maybe he's owned the house for a good 3 or 4 years before he gets married. So he put the down payment down and he's been making payments towards the mortgage, and then he gets married, right? So as you're aware, once married and they're paying the mortgage, they're paying it with community property funds. So now the other spouse starts sort of accruing an interest, if you will, in that property. Can you talk about sort of the method, I guess, whether a 50,000 foot overview or however you'd like, on how you sort of determine the other spouse's respective interests in it?
Yeah, actually, it's a very common thing because next to a business, homes or houses or condominiums, right? These are all homes, is the most valuable asset in marriages, right? So, so that is one of the most common issues, and I get a lot of calls from many attorneys. And thankfully, there is case law that deals with this. And without talking about the case law, the basic concept is this thing called contribution and apportionment. So in this contribution, back to your example, husband, for 3 years was making mortgage payments. That's called principal reduction. That's a form of contribution. His down payment was also a contribution. And also getting the loan was his contribution. And then during marriage, that same loan that this husband in your example brought into the marriage was paying down the principal of the mortgage. And in doing so, the community gets this thing called an equitable interest. As you said, they're accruing an interest. It's called an equitable interest. It's not a legal interest. But then from that, we have this formula called, again, a fancy term, pro tanto apportionment, right? So we talked about the contribution, right? But from that, we get these percentages. And then these percentages, we in fact apply those percentages to the appreciation from date of marriage until the date of division of that property or date closest to trial. But here, the premarital appreciation, if in your example, the property increased in value before marriage, the husband, in your example, gets to keep that, then the community divides essentially the appreciation during marriage, which is from marriage until date of trial or date of division. And then they also get their contribution back. But the misconception here is that husband, for example, while not within 3 years, but I've seen where husbands, for example, 10 years before they get married, have refinanced that property multiple times, and they've taken equity out. And then during marriage, the community, or at least the outspouse or the wife in this example, thinks that she's paying off a $3,000 mortgage and thinks that every penny that the community pays goes towards this thing called, the contribution of the community, right? But sadly, the more you refinance a property, it dilutes the contribution towards the original mortgage, which is the basis for the credit towards the contributions and also the pro tanto apportionment formula.
Well, you took the words right out of my mouth, because literally my next question was if you can sort of explain the effect of refinancing and specifically a cash out refinance and how that affects the apportionment process through in a divorce and trying to determine the respective interests or share that the parties have in their home. So thank you for touching on that. It brings up another interesting point, and something you probably hear about a lot, we certainly do, is in this hypothetical, we have a spouse that says, well, it's my house. And I give them a very sort of broad understanding of the law, or at least I attempt to give them an understanding of the law. And they said, no, wait a minute. He or she signed an interspousal transfer deed, right? They transferred it over to me. It's done. Can you briefly explain how it sort of interplays with when you're trying to do an analysis of a spouse's share in a property when there is in fact an interspousal transfer deed? Does that make sense?
No, it does. There's case law and code that talks about this. So one thing that people forget is that when you divide a house that has essentially been brought into the marriage, right? It's less about title and it's more about contribution. No, I don't want to bring this up, but it's not about Family Code 2581. It's about Family Code 2640, right? And then I hope I'm not being too technical, but anyway, so this whole thing is called Moore Marsden. So that's what everybody talks about when it comes to dividing the house. That first and foremost has to be separate property. There is no Moore Marsden issue when it's community property. Okay, so if back to the example with a husband, if he in fact refinances the property, let's say, during marriage, and has the wife, in this case, sign an interspousal transfer grant deed, all she did was essentially not get a piece of the appreciation or the apportionment of the appreciation from marriage until date of settlement. Because you need a separate writing or a separate waiver for the contribution that the community paid towards the reduction of the principal of the original mortgage. Again, as I mentioned earlier, the more you refinance, the more it dilutes the the original mortgage being paid down, but the way the case law works is it has to do with the contribution has to do with the acquisition of the property. And when you refinance, and in your example, do a cash out, you're not essentially whenever you make a mortgage payment, you're not paying down the mortgage that was the original mortgage. You're really paying down part of the original mortgage and that cash out refinance, which has no bearing whatsoever in paying down the original mortgage. So the misconception often is, and the surprise always is, we've been paying $3,000 a month, but when the husband bought the property, he was only paying $500 a month towards the mortgage. But in the wife's eyes, for example, they think that why can't all $3,000 go towards that? And just to be clear, it's only the principal portion that relates to the original mortgage, nothing else. Like, for example, the interest on that mortgage does not even count.
No, I think you hit the nail on the head, and this can get a little bit complex. But again, you know the importance of understanding what is involved with making these determinations, right? For instance, it's just the principal that's considered, and then the implications or consequences of a refinance and how that affects, in essence, right, in the end, the apportionment and what both spouses effectively care about.
Can I just say something?
Yeah, of course.
Yeah, so where attorneys are needed, like you guys, is that, for example, what happens is husband applies for a loan to refinance the property during marriage, his separate property, right? And he uses essentially the credit of the community, the net worth of the community, and also the income of the community, because his income is presumably community property, right? And then they turn around and have the wife, in this example, sign, presumably under duress, this interspousal transfer grant deed, right? And that's where lawyers now have to come in and make sense of this thing, because there's this presumption, as you know, that they are, the ones that sign it during marriage are presumably unduly influenced. And that becomes a legal argument now. That's why you guys are the ones that they have to call first, because I take your lead in this case.
No, it's so common as well. And I think the legislative intent behind this presumption is that you may have a spouse, and this is kind of a common fact pattern, that they say, my husband just said to sign this, or my wife said, just sign this really quick, not understanding the implications of signing that document and what it could potentially do with respect to their interests, right? Their share of the value of that home. I had another question for you, and this is one that is common, and I don't know, I'm really curious to hear your thoughts on it. Spouse has a business that they primarily work in cash, right? And then maybe for the purposes of child support or spousal support or both are saying, what money? I have no money, right? But you have the attorneys, and a competent one will at least like to point to, but you drive a Mercedes-Benz. You live in maybe this beautiful home or whatever. So when you deal with those kind of fact patterns, and you're maybe retained to say, follow the money, or at least help try to explain how this person who is saying, I have no money, lives this particular lifestyle. Does that make sense?
No, and it does. And there's no money to follow, because these people that often deal in cash never deposit their cash. For good reason. They don't want to have any record that can be used by the IRS, for example, to assess a higher tax liability. So there's this thing called a net worth test that the IRS, in fact, uses. And I believe this started a long time ago with Al Capone. They said, and they got him on essentially tax evasion, right? So they go, how can you live this Al Capone lifestyle or this gangster lifestyle, right? And make almost no money. Well, the same thing happens here, right? So if people deal in cash and they don't report the cash, they don't deposit the cash, there is no money trail, and there is no paper trail, more than likely, right? So the only thing we can look to is, in fact, the lifestyle. But now we run into a problem, and this comes to managing expectations of our clients, is that if, in fact, they live a meager lifestyle and they're stashing this cash, we can never prove it. We can never prove it.
Yeah, I often tell clients, I'm like, how far down the rabbit hole do you really want to go? And how much do you want to spend going down this rabbit hole, right? It's doing sort of a cost benefit analysis. I'm speaking your language now on maybe pursuing something like that, where in the end is if someone is, determined enough to hide the money, they probably could. And it does create obstacles in trying to prove otherwise, right? That they can't afford the child support or spousal support or both. I did want to ask another question as it pertains to, calculating child support and spousal support. And you kind of touched on it with your discussion with Michael and to some extent during our discussion here. If someone, you mentioned something about tax returns presumptively being correct, right? As far as the family code is concerned, excuse me. But we also know as small business owners, I'll use, for example, you have a lot of latitude and discretion in sort of determining, kind of what's an expense and what's not, and maybe even being able to manipulate sort of quote unquote revenue or income. So, what are just, I guess, from a 50,000 foot overview, what are things you do from your side of the practice in trying to determine what the real income is?
Well, hopefully, we're moving away from cash. That's going to make our lives easier. So while we can never prove 100% of the income of most businesses that deal in cash, we're starting to prove more and more because now things like, historically credit cards are being used. Customers on account, or you invoice a customer and they pay you a check. Those are easy. And now we're using platforms like Zelle or Venmo. That makes it a little easier, right? And hopefully that's connected to a bank and we know of that bank account, right? But for assuming that it's 100% cash, what do we do? Again, we have that problem. We can't do it. So again, if it's 100% cash and they want to hide it, we can never find out. But I'm seeing less and less of that. What I see more is this, what you call latitude, right? They're using their broad discretion and calling something an expense that it's not an expense. Yep. And the IRS will beg to differ on your broad discretion because the IRS is very clear about what is an expense. As a matter of fact, they have a presumption that it's personal. You have to prove that it's business. So the IRS has this presumption, right? But even with the IRS, they want this thing called substantial compliance, not this 100% compliant. They want something substantially compliant, right? So if I'm a taxpayer and I have this discretion, maybe you'll get a pass. It's this thing called materiality. Because ultimately, while I don't do DishoMaster, I can imagine where I'm off maybe $500 a month in their income, and that's going to mean pennies or a couple bucks in the ultimate support, right? Mm-hmm. So there's this thing called cost benefit, as you said. Like, are we really after this thing called perfect and complete information to get 100% accurate income? No, we're trying to get something that's reasonable, because ultimately when you take the numbers and you put it into your DishoMaster, when you're a couple $100 off, or even $1,000 off, depending on how much money they make, it may make no difference whatsoever. So in this cost benefit trade-off, you have to say, what's it really going to cost me to pursue, this concept, which is elusive, called 100%, we know what the business makes.
Yep. Another question, I'll keep this one quick, is let's say, for instance, before I get married, I have a savings of $100,000, right? So I get married now, and maybe I add my spouse to my account where I'm holding this $100,000. Now we're getting divorced, right? I want to make the claim that, hey, I came into this marriage with that $100,000. I'm entitled to get that back. There's no community property interest, meaning my spouse has no entitlement to it because I had that money. I earned it before I was married. But I added my spouse to the account. There's been several transactions in the account. From your perspective, from the practicing perspective, how do you determine, how can you sort of defend my argument if I'm looking to retain you to say, look, help me effectively prove that money was mine, notwithstanding the fact that after I got married, we started sharing this account and money was going in and out?
It's always a problem, and to your viewers, know this. If you have a separate account, do not commingle it.
What does commingle mean?
Okay, commingle is essentially when you take what is yours before you're married and you combine it with what is the community's, right? Because now, if you're making a separate property claim for what is presumptively acquired during marriage, the burden is going to be on you. I don't want to talk like an attorney. I'm just saying that I'm tasked with trying to determine the character of this commingled bucket of money. Now, it would help if, for example, you had the bank statement of $100,000 right before you got married, and then that balance never went below $100,000, but that's never the case. It is never the case, especially in long-term marriages, okay? So we have to do these. So there's case law on direct tracing, which is going to be the easiest if you don't commingle it, right? That's the easiest. But there's also case law on this thing called, family expense method, or it's called the exhaustion method or the indirect tracing, however you want to call it. Ultimately, we have to essentially try to unbundle this commingled account to see if, in fact, the character of the person that brought the money into this marriage that was his separate property, that character has still been preserved. But And there's also this with respect to exhaustion, there's a presumption that community property is used first. But of course, if the community spends more than its community income, guess what? Your $100,000 is now going to be eaten into.
No, again, that's a common issue that we run into, and I think you couldn't have explained it any better. And even sort of the term that we use from a practitioner perspective, tracing, right? I think it's aptly titled because from your perspective, that's exactly what you're doing. You're trying to follow the money and ultimately try to help, in our fact pattern, this person show that, yes, that $100,000 is still mine, right? Notwithstanding the fact that it was commingled. And now we know what commingling means. Greg, wonderful speaking with you. We could probably spend hours doing this.
We have.
And I look forward to
on our cases.
Exactly. And I hope we could do this again, and
same here.
We'll get some feedback. And I'm sure there's going to be plenty of people that watch these videos that are going to say, I wish he asked this. And I'm sure after I'm done watching, I'm going to be like, I wish I asked him this. So look forward to doing it again.
We'll do another long form.
I like it.
Yes.